Minutes to the Federal Reserve's May meeting show that Fed officials agreed the next move after that May rate hike was less certain due to uncertainty about the impact of the lagged effects of tightening and tighter bank credit policies that could be coming. Many Fed officials said the Fed needed to, quote, retain optionality after that May hike. Some saw a need for additional rate hikes due to slow inflation. The inflation progress coming down had slowed. And several said that if the economy evolved the way they thought, they did not see a need for further rate hikes. But some wanted to stress in that meeting it was important for the Fed to communicate that rate cuts were not likely this year and that they were not ruling out further hikes. So they wanted to retain that optionality. That runs throughout. They also said, they stressed it was important to raise the debt limit to avoid risks to the economy and financial systems. There were several comments on the debt limit. I'll get to those in a second. On the economy, the Fed should be ready to, on the debt limit and banking system, the Fed should use its liquidity tools to mitigate future financial stability risks. Could have been talking about the banks there. Could have been talking about the debt ceiling. Unclear. Tighter credit conditions, though, from the banks were seen weighing on economic activity, households and firms, and hiring and inflation. But they stressed it was too early to say what kind of effects they would have. Some saw only modest effects. Fed rate hikes had contributed to restrictive financial conditions. They saw slower GDP, a labor market softening, and a need to reduce inflation. At the time they met, it was interesting. They talked about banking conditions actually having improved from the worst days of the Silicon Valley Bank failure. Consumer spending was strong in the first quarter. However, it was expected to slow. The labor market was seen very tight. Some saw signs of easing of labor market conditions. For example, they noted less difficulty in hiring. Wage growth, however, was still too high, and inflation was said to be, quote, unacceptably high. And again, they repeated this idea that inflation was more slowly than they had expected. And again, on debt default, there was concern about it expressed at the meeting. It threatened a significant disruption to the financial system and the economy. Also, commercial real estate was listed as a risk to the banks. One final comment, the staff continued to forecast a mild recession in the fourth quarter of this year and the first quarter of next due to tighter credit conditions from the banks. Guys?
Very interesting, Stephen, and I'm going to ask you to stick around as we get a little further reaction there. There's a lot to unpack in Steve's recitation of the minutes, and to do so, let's bring in Aditya Bhave, senior economist with Bank of America, and Jerry Castellini, president and CIO of Castle Ark Management, along with Steve Leisman. Aditya, let me begin with you and ask you to give me your impressions of what the Fed minutes said there and how they comport with your baseline case that the Fed has reached its terminal rate.
I think the Fed minutes, as well as Fed Governor Waller's statement today, are very much consistent with our base case that June is a close call. We still don't expect them to hike in June, but it's very much on the table. There's basically three conditions that need to be met for the Fed to hike in June. The first one is a deal to raise the debt ceiling. The second one is that regional banks, the stress around regional banks remains somewhat contained and the associated credit tightening remains contained. And then the third one is that the data remain hot. So if you get something like 200,000 non-farm payrolls on the 2nd of June, and on the 13th of June, if you get 0.4% on the core CPI, then June will be strongly in play.
Jerry, there are, as I listen to Steve there, and I want to go back to Steve in just a minute, but as I listen to him, it sounds like the Fed is describing many, many areas of potential risk in the economy, and yet the central number that they seem to have their eye on, which is inflation, remains stubbornly high. And that's a sign of an economy, basically, that is humming along quite well. There are obviously exogenous factors that can affect price levels and so forth. How do you read what the Fed is saying here, and how do you interpret then what its next moves may be?
Sure. Two basic concepts. They're trying to explain, as they always do, how the current conditions are. Somewhere around May 10th, whenever they met, they wanted to describe exactly how they felt the underlying economic trends were, and they expressed that. The more important thing, and the thing they led us to believe in these comments, was that their job is basically done. inflation, any effect on inflation has to take months to impact from a policy perspective. And when you put the policies that they've put in place, 5% increase in rates overall in the last year or so, there's more than enough headwind against inflationary forces to see and expect to see that decline now, basically, or continue the decline as half. And I think they're done.